Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, independent financial advisor and owner of Elevation Financial. Thanks for joining me today. Glad you're here as always. We're going to talk a little bit about risk today. Going to be a short episode, more of a pep talk, kind of a thing to think about kind of episode. Nothing tangible or necessarily like toolkitty or anything, or toolkitty. That sounds interesting. Not like a toolkit or a practical thing, but more of a thoughtful kind of episode to think about. So I want to talk a little bit about risk, and specifically comparing the risk of loss versus the risk of missing out. So let's talk a little bit about risk. Risk is different for all of us. Risk is the idea of doing something with the idea that it might not work out, that there might be a loss involved, that there might be things that don't go well, but the trade-off is potentially something good. That's a risk we take. We take risks all the time in life. We take risks when we take a new job. We take risks if we start a business. We take risks when we walk out the front door because who knows what could happen. But we do these things because we believe that the outcome is going to be hopefully better than the risk or the downsides. So, Jennifer is stopping by on Facebook Live. I'm going to go ahead and put her comment on there. Jennifer says, put it all in black. That's the kind of risk we talk about sometimes as well, the gambling risk. So thanks, Jennifer. So as a reminder, for those who listen on the podcast, I do broadcast these on Facebook Live, YouTube Live, LinkedIn Live, and Twitter Live. So if you ever want to stop by live, you can join me in real time as well. So thanks, Jennifer. Glad you are here. So I'm talking about this right now because of the markets, the financial markets, the investing markets. You know, we're looking at some volatility this year. At the time of this recording, it's later 2022 at this point, but the first part of the year in 2022 has been pretty rocky. We've had a significant downturn in the markets. And again, the time of this recording, we're seeing somewhat of a recovery happening. We're seeing an uptick in the markets. And my usual caveat about crystal balls applies. I don't have a crystal ball. None of us do. We don't know what sort of factors are going to come into play to affect the markets, trading sentiment, financial indicators, the economy, legislation. Lots of things can affect the market valuations that we see. So right now, the markets are a little bit scary. Not as scary because, again, things are trending upward, but we don't know what the future holds. Although I've talked about this in the past, long term, we do see a trend upward over time. I'm going to pause for a second. Leslie is stopping by on Facebook as well. Leslie says, I am normally quite risk tolerant, but when COVID first hit and the markets went haywire and my job went dormant, that changed for a while. That's a great point, Leslie. So our risk tolerance can change over time as well, depending on the circumstances. And it's always funny. As a financial advisors, we do these things called risk tolerance questionnaires. We give our clients these things to fill out, and a lot of it is due to satisfying regulations and having a starting point for conversations, which is all valuable. But it's no one ever really knows how they're going to react until it happens. So a lot of people might say, "Oh, well, I'm pretty risk tolerant and I'm fine, investing in this way, and it's okay if it goes up and down." But then when it really happens, we get a real view into how we actually react. Leslie also followed up on Facebook saying, once I made back the initial loss, I paused for a while until my job came back. Missed a lot of extra upside, but I slept at night. So Leslie's kind of indicating that, there is some value, even if the math doesn't work out to be favorable, there is value in peace of mind, which is true. So thanks, Leslie. I'm glad you stopped by for that comment. So I'm going to talk today about a different kind of risk. We always think of risk in terms of investing as, what can I lose? Risk is kind of seen as dropping in value, volatility, our account value going down. That is kind of the typical idea of risk that we see. We see that risk is, I'm afraid of losing money. There's a risk of losing money. We'll talk a little bit about what that really means in a minute, but I'll go ahead and say that the risk of feeling like you're losing money is a more accurate way of saying it. That's sort of what we see as risk. But there's a different kind of risk. The risk of volatility is only one way to look at it. The other kind of risk is the risk of missing out on favorable returns. There is a risk to not taking risk, if that makes sense. So I want to talk a little bit about that today to give you some perspective on how to think about this. So a lot of times people will say, hey, I don't want to take a risk because I don't want to lose money, or I don't want my money to go down too much, or I don't want to see a lot of volatility. I don't want to see ups and downs. That's the risk they're thinking about. But there is a risk to not investing aggressively enough. And that risk shapes out in the form of the options and the resources you have later in life. And this depends on the types of risks you take now. So one example, let's look at inflation. Inflation is high. At the time of this recording or this show, inflation is high. It's all the media wants to talk about, inflation, blah, blah, blah. It's everywhere. We're always hearing about inflation, being bombarded left and right. So it's on our minds. So it's a great time to talk about it. So inflation and exposure to inflation is a risk. It might be tempting to invest very conservatively, even stay in cash, or invest so conservatively that maybe you don't see a lot of volatility, but your returns are very low and very minimal. While this may feel lower risk, you are at risk of being exposed to inflation. Exposure to inflation means your money is not going to keep up. It means your money is not going to grow at a rate that keeps pace or outpaces inflation. That's a risk. That's a risk you're taking where your spending power and your wealth is actually being eroded over time because you aren't being aggressive enough with your money. You aren't taking enough risk with your money, which translates to a risk of inflation exposure. That's one example. There's another example of just the way this plays out in financial planning. I ran a couple of scenarios for examples here to kind of talk you through it. So I've got two scenarios here. We're taking a 30-year snapshot. And we're taking two examples of investing. Both examples, we're investing $700 a month over 30 years. The first example, we're investing in getting a rate of about 5%. That's pretty conservative. That's something you might get from a pretty balanced investment, mixture of bonds, stocks, heavily weighted toward bonds. You might see that rate of return for a pretty darn conservative portfolio. So we'll say 5%. Over 30 years, investing $700 a month, you end up with a little over $500,000, specifically $558,086. That's what you end up with. Okay, sounds like a reasonable amount of money, right? Let's take the second example. In the second example, we are investing more aggressively, and we get a return of about 9%. Again, I'm not saying these are necessarily exactly feasible or not. These are just hypothetical examples. So let's say you get 9%. $700 a month, same time frame, 30 years, you end up with over $1.1 million, specifically $1,148,983 at a 9% rate of return. So over, twice as much, obviously looks great. What does that translate to in actual spending power at retirement or financial independence or work optional, whatever you want to call it? In the first example, where we got 5%, you end up with an annual income of about $22,000 a year if we follow the 4% rule. Again, I'm not going to talk about the merits or pros and cons of the 4% rule. I'm just saying as an example, we're going to use the 4% rule of withdrawal. That gives you basically an income of about $22,000 a year. In the second example, your income is about $45,000 to $46,000 a year using that same rule. So the investor in the first example thought they were being low risk, but they ended up having a pretty high risk of not having enough money later to support their lifestyle. They were exposed to inflation risk. They were exposed to spending power risk, and that's a risk they took. That's a risk you would take in that example, the risk of not capturing the returns necessary to support your lifestyle later in life. So that's kind of an example of the differences you see and how it plays out when you're comparing risk and comparing the risk of not being aggressive enough. Now, does this mean that you should be aggressive? No, I don't know that for sure. I don't know who's listening to this specifically, and that's all dependent on your specific personal situation. So, if you have a 3-year time horizon, then that's going to look a lot different. And I'm not saying to be aggressive, but, let's say you're 30 years old, 35, you've got 30 years to save, that this is an example where this applies. Even a 10-year example, a 5 to 10-year example, this still applies to those examples because the risk is still there. The risk of not being aggressive enough and getting to where you want to be. Another example, let's say you try to time the market. This happens a lot as well, especially when markets get scary. People try to time the market. And this looks like going to cash. Like the example of what this looks like is they go to cash when they get kind of concerned or fearful of the market. So there is a Dimensional Fund Advisors white paper that does a lot of research on this stuff. And one of the white papers is an example of investing $1,000 over a 25-year period, and in different ways or different scenarios in which you basically exit the market at certain times. So go to cash, for example. So in that 25-year time period, if you start with $1,000 and in 25 years you stay in the market, you end up with over $10,000. Pretty, basic minimal example. 1,000 going to 10,000. Okay, we can kind of capture that in our minds. Makes sense. So what if you miss the best week of the market in that time period? If you miss 1 week of the market, your money grows to about 8,600. So you lose a couple $1,000, fairly significant. Again, if you multiply this by bigger numbers, it becomes even more significant. Let's say you miss the best month of the market. Again, this is looking at 25 years of a time period here. So let's say you miss the best month. Your return shrinks to about 8,200. You miss the best quarter, 7,300. The best 6 months, 6,700. So we're almost down to half the return we could have gotten simply by exiting the market for 6 months. And again, this is the best 6 months of the market. So we don't know when those best times are going to happen. So the risk you take of going to cash and thinking you're being less risky actually ends up being a high risk for experiencing a loss in wealth later in life. That's a risk we want to think about. So again, I'm not saying that it's bad to be conservative. It's appropriate for some people. I'm not saying it's bad to adapt, these situations for your specific financial circumstances. But in general, it's not just the risk of volatility that we want to consider. It's the risk of missing out on returns. It's the risk of not having the resources we want later in life. It's the risk of missing out on those best time periods in the market. And it's really easy to miss out on those best time periods. It's really easy to do because human nature works against us. Our emotions work against us. It's human nature to buy a bunch and invest when things are up. And it's also human nature to sell off and go to cash and get scared when things are down. So our emotions work against us. So it's not easy to do. But I want to leave you with this thought process so you can think about it yourself and not just see risk as a one-dimensional aspect of, hey, lowering risk means jumping out of the market or being in cash or being conservative. That's how being low risk feels to us. But in reality, there is a second dimension of risk. And that second dimension of risk is not capturing the upside you would have gotten had you taken that risk. And that's a very real risk. It can make the difference between having a comfortable retirement or a comfortable period of financial independence later in life, or having to work longer, or having to cut your lifestyle or make other sacrifices. So again, the stock market overall, historically, has been one of the greatest wealth building tools in our history. It allows us to participate in the innovation, the advancement, the profitability, and the growth in companies in our country and in our world. Now, there's lots of commentary we could make about, capitalism and socially responsible investing and, the future of our society. And that's a whole big can of worms I'm not going to get into. I'm simply going to segment this to say that the stock market has played out historically to be a great wealth builder. And if we let it work, and if we take the necessary risk and we invest appropriately, it has built wealth for a large number of people who have stayed invested and used it to their advantage. And again, we're participating in innovation and growth and profitability in the companies that make up our economy in this country and in this world. That's what the stock market fundamentally lets us do, is participate in that growth and that innovation. And, a couple phrases come to mind. A friend of mine who's also an advisor, who's in a mastermind group with me, shared this phrase I really like. He said that market volatility is the price of admission for investing in a vehicle that historically returns 8 to 10%. If you want those returns, the price of admission is stomaching the volatility. The price of admission is understanding that volatility comes with it. So remember that. Also remember that it's important to focus on time horizons, not emotions. time horizon is one of the most important factors to think about when determining risk. If your time horizon is 2 years, that's a great example to be in cash. That's a great reason to be in cash. If you absolutely need money in 2 years, use a money market, use a savings account, use cash. If your time horizon is longer, 5, 10 plus years, that's a great reason to consider investing. Your time horizon should dictate a large part of how much risk you want to take. Also, remember that as long as you don't sell, you still hold the asset. I had a conversation with a client recently about this, and we talked through it as an example of, hey, if your house value goes down, do you sell your house immediately because you get scared? No, you hang on to it because you still own your house. It's still providing utility to you. If you own a piece of jewelry and the price of gold goes down, do you sell your jewelry because you get scared? No, you hang on to it because you still own the asset. So think of it this way. You still own the asset if you own a stock or a share of a mutual fund. When you own, let's just say a mutual fund, for example, because they're pretty common. So a mutual fund is an actual share in a fund that invests in these companies. You're actually owning something that's not necessarily tangible because it's on paper or it's digital, but it is something you own. You own an asset. So just because the price of the asset goes down doesn't mean you've lost money. You only lose money if you sell it. You still own the asset. The price will still fluctuate. You still have that in your possession. So think of it like your home or a piece of jewelry or some other asset. If we look at the account balance, we just get scared. But if we think about, hey, I still own the asset, and if I hold on to it, and there's a reasonable expectation that it will go up again, that sometimes helps reassure us when we get scared. So again, think about that. I'm going to come back to a few comments here as we wrap up. Jennifer on Facebook again says, no pain, no gain. I'm on the other end, no right or wrong. Jennifer, I appreciate you sharing that. I love the attitude. And Leslie also stopped by again to say, I'm back in the market and throwing extra in too, but I couldn't handle the risk in both places at the time. And that's okay. Again, we have to know ourselves. Leslie also joked and said, guilty of trying to time the market. We're all subject to emotions. This is not meant to be judgmental or meant to make anyone feel bad about this. It is meant to give you some perspective to think about. So we've all done this. We've all been subject to emotions. We're all human. So I'm hoping this gives you another tool in your toolbox and your thought process to think about risk. Again, reviewing, risk is not just the risk of volatility or loss. There is a very real risk for not taking enough risk, which can play out later in life to being problematic. So think about the risk of not being aggressive enough or the risk of not capturing the returns by taking that perceived risk. So enough about risk. I've said risk over and over. I think we get it. So as always, I love to chat. So if you want to stop by my website and go to elevationfinancial.com, you are welcome to book a complimentary money session on my homepage. There's a big friendly button there that will help you do that. And I'm happy to talk over this or anything else that's on your mind. There's no fee for it. Whether you decide to become a client or not, either way is fine. Happy to answer questions. Again, that's elevationfinancial.com. As always, thanks for joining me today. Have a great day. We'll see you next time.